Hello everyone, and welcome back to Financial Mo. Today, we're diving into a topic that's crucial for anyone looking to build wealth and secure their financial future: portfolio diversification strategies. But don't worry, we're going to break it down into simple terms so that everyone can understand. So, what exactly is portfolio diversification? Well, it's essentially the idea of not putting all your eggs in one basket. Instead of investing all your money in a single asset, like stocks or real estate, you spread your investments across different types of assets. Imagine you have a basket filled with different fruits: apples, oranges, bananas, and grapes. If something happens to one type of fruit, like a bad harvest or a sudden price increase, you won't lose everything because you still have the other fruits to rely on. That's the basic principle behind portfolio diversification. Now, let's talk about some specific diversification strategies you can use in your own portfolio. Strategy 1. Asset allocation. This involves dividing your investments among different asset classes, such as stocks, bonds, and cash. Each asset class has its own level of risk and return, so by diversifying across them, you can reduce the overall risk of your portfolio. For example, let's say you have $10,000 to invest. Instead of putting it all in stocks, you might decide to allocate 60% to stocks, 30% to bonds, and 10% to cash. This way, if the stock market takes a dip, your bond investments can help offset some of those losses. Strategy 2. Geographic diversification. This involves investing in assets from different countries and regions. By spreading your investments globally, you can reduce the risk of being too heavily exposed to any one country's economy. For instance, if you only invest in companies based in your home country and there's a recession, your entire portfolio could suffer. But if you also have investments in other countries that are doing well, it can help balance out those losses. And finally, strategy 3, sector diversification. This means investing in different sectors or industries of the economy. Just like with asset allocation, each sector has its own risks and potential for returns. For example, if you have all your money in technology stocks and the tech sector suddenly experiences a downturn, your portfolio could take a big hit. But if you also have investments in sectors like healthcare, consumer goods, and energy, it can help protect you from losses in any one area. Now, let's talk about the advantages of portfolio diversification. First and foremost, it helps reduce risk. By spreading your investments across different assets, regions, and sectors, you're not putting all your financial well-being at the mercy of a single event or market movement. Secondly, portfolio diversification can potentially improve your returns. While diversification won't guarantee higher returns, it can help smooth out the peaks and valleys of your portfolio's performance over time. This can lead to more consistent growth and may ultimately result in better overall returns. So there you have it, folks. Portfolio diversification is all about spreading your investments across different assets, regions, and sectors to reduce risk and maximize returns. By following these strategies, you can build a stronger, more resilient portfolio that can weather the ups and downs of the market. Thanks for watching, and we'll see you next time.